Welcome back. We're in a most valuable discussion with attorney and CPA Dennis Sullivan concerning some of the major concerns that families confront when dealing with tax, estate, and retirement planning issues. Now, earlier in the show, we were talking about the review of your estate. And could you please elaborate a little bit more on that?
Well, we talked a little bit about the 19-point trust estate and asset protection review guide. There's a lot of points on there. But maybe we ought to talk about the taxes. The way to get a copy would be to visit the website, where you can sign up for a workshop to learn more about how to review your plans if you have them, or if you don't have plans, to create a plan, or you can call the 800 number on the screen.
Now, what kind of problems are there?
Well, there are a lot of problems with taxes, in particular estate taxes. In Massachusetts, the estate tax will start on everything above $1 million. And next year, in 2011, same thing for the federal estate tax as well. It's coming back and can reach as high as 55% next year.
Wow.
Although there's no federal estate tax at this point in time, Massachusetts residents need to be careful about that, because the tax applies to each person on assets above $1 million. So particularly in Mass, you need to make sure to get the two tax-free amounts for a married couple.
Wow.
Very important. As I say, next year, 2011, that could cost over $500,000 for a married couple if the right steps aren't taken.
That's huge. And is there anything people can do to reduce an estate tax?
Well, yeah, there's quite a bit that can be done. We go over that at the workshop, and there's information on the guide, so that there's quite a bit available to do that. As a matter of fact, we have the slide up. Clients actually have the opportunity to pick exactly where the funds will go. As mentioned, for a married couple, reminds me to go through a case study at the workshop of Tom and Susan that have actually been clients, and we'll walk through how just by adjusting their planning, coordinating the assets to the right trust, they were able to save actually $750,000. So it's a good idea to make sure the planning's reviewed. We tell people at the workshop how to do it. Among the benefits, they can save $250,000 or more, depending on the size of the estate.
Yeah, we don't always take that into consideration.
Well, that's true. But you know, particularly this year, there are changes affecting IRAs, and you've got to be careful not to be lulled into a false sense of security on the federal side with no estate tax. So people really got to pay attention to the changes that are happening in the law, and for our clients, we'll be keeping them posted with information and newsletters throughout the year, but we go through these opportunities and the dangers of what could happen with half of everything going to the government. Nobody wants that.
Nobody wants that. And is it true that the IRAs may be taxed as much as 70%? How does that happen?
Well, people are astounded to hear that. I know we had a slide on that.
Right. Here we go.
The big problem is 50% when the estate tax applies comes off the top on a sample $1 million IRA. So we've got a taxable estate, $500,000 going to the IRS. Of the $500,000 that remains, that's not been taxed, so that's subject to a 40% tax as the beneficiaries receive that. So that income tax at 40% is another $300,000 on taxes, leaves the couple with $300,000 left for their family, or 30% of the original amount. Now that will apply again back next year. We've got a little bit of a holiday in 2010, but the state and federal government are expected to change things, so it's be on the lookout for these changes to make sure that's incorporated into one's planning. Very important.
Sure.
Most people are astounded to hear that level of tax.
No kidding.
Very surprised to hear it.
No kidding. Is there anything that can be done to reduce or eliminate this tax?
Absolutely. In fact, 2010 is a big year to do that. It can be completely eliminated with conversion to a Roth IRA. Roth IRA, there's no income tax at all, so the bottom 40% tax is completely eliminated.
Wow.
Got a window of opportunity as well in 2010, because previously the limits were $100,000 in gross income. Anything above that would prevent you from converting to a Roth IRA. But you really need to be careful. It depends on analysis of your tax position now, future projected tax down the road. So you have to study it to see if it makes sense to do the conversion to a Roth IRA, eliminate the requirement of required minimum distributions going forward, as well as eliminating the tax. But as I say, there needs to be a tax on the conversion, so you really need to look at the tax rates now or over the couple of years that you could spread that tax rate over. But be careful, it's projected that the income tax rates are going to be rising. So it's really something that you need to study. There's been a lot of talk about the conversions, want to take a look at it in context with all your planning, and then decide what makes sense for you and your family.
Right, but you looking at it like yourself, Dennis.
Right.
I mean, I would have no. It's so complicated. I'd have no idea what I was doing. So it's essential that people come to you.
Well, we're happy to help people, to teach them the law and show how these rules work. But we're happy to help them. They can come to a workshop to learn more about it. We've got a workshop on the miracles of IRAs. We've got workshops for clients and others coming up on estate taxes and the Roth conversion, the 70% tax. So a lot of what we talked about today, we go into more detail at the workshop, and people can call the 800 number or sign up on the website for that information.
Now, also, what about a trust? Can a trust help reduce the 70%?
Well, a trust can do a lot, and the short answer is yes, especially for grandchildren. And you know, as we kid around and ask people at the workshop how many people have grandchildren, invariably 90% of the hands go up. So most people have grandchildren, and they'd like to see them benefited. Now, you don't actually need millions of dollars or hundreds of thousands of dollars to do a lot for a grandchild. I think we've got on the screen that the taxation for an inherited IRA is actually dependent on the age of the grandchild. So as you can see, Patty, for a 1-year-old, even a modest amount like $100,000, and even a taxable IRA, if that's inherited through a retirement plan trust, those distributions can be grown on a tax-deferred basis, even at a modest 6%, and provide over $2.4 million in distributions protected for a grandchild over their lifetime.
That's huge.
It is.
Wow, wow, wow.
Another example for a 12-year-old, not as much time for compounding tax-deferred growth, but as you can see, it's over $1.2 million. So clients, again, don't need millions of dollars. They can help grandchildren, even with a modest $50,000 or $100,000 amount. In particular, for a grandchild, you want to protect it in a retirement plan trust so that it's used for college down the road. It's not used to buy a fancy car, but it's used for things the grandparents would want, and the children can look after it for the grandchildren, so it's there for them for the future, for the important things that are there.
That's fantastic.
As you can see, there's quite a bit that can be done.
Absolutely, leaving a legacy and giving peace of mind. Why should people work with your law firm quickly?
Well, the truth is, Patty, that we enjoy what we do, and we're committed to education first and foremost. We've written a number of books. We have reports. We have 4 workshops a month that people can come to. We have a lifetime protection program. So we not only guarantee education and value opportunities for clients, but we do it day in and day out with education, helping clients on the phone or in meetings, empowering them, putting them in charge of all of their planning, because our first objective is to put them in the driver's seat so that going through the 12 steps in order to create an effective plan, they're able to accomplish all their goals and objectives. And then we work with them for the rest of their life to make sure the plans are going to work the way they should. Despite the changes in the laws we've talked about, there are significant changes, and we're here to help clients to understand those taxes and other changes so that the plans are going to work for them to protect things for themselves, for their spouse, protect their homes, life savings, and eventually a legacy for children and grandchildren.
That's wonderful. Well, I can't thank you enough for joining us today.
Well, thanks for having me, Patty.
Appreciate
it's been a
it.
pleasure. You're welcome.
That's it for this edition of Leading Experts. We'll see you next time.